is when there's an equal odds of the Fed going into a meeting of either hiking or cutting rates. So when there's a 50-50 chance of the Fed either raising or dropping rates, then we're at neutral. Traditionally, this has been right around GDP growth. So if the market is looking for a neutral rate around 2%, that means long-term growth for the economy is only around 2%. So I think the neutral rate has got to be higher than here.
Yeah. The Wall Street Journal editorial board, subject of a piece this morning, Powell to the markets, take that. Why is Jay Powell not concerned about the signals that the market is sending? 298 of the stocks in the S&P 500 are in a bear market territory, coupled with the Russell 2000 and the Dow Jones Transportation Average. What is he looking at?
Well, look, once you get into saying what the equity market is telling the Fed, that's the tail wagging the dog, right? So monetary policy should be based on the entire economic situation of the United States and the outlook going forward. And what I'd say to the equity market is you need to remember, why are we raising rates? We're raising rates because the U.S. economy at the moment is booming. And we are now only at the levels of the Federal Reserve was when Bear Stearns went out of business. So going all the way back to 2008, we're only at we're only at the short-term interest rate level that we were right after Bear Stearns when the Fed cut 50 basis points.
Yeah.
Plus, we have $4 trillion on the balance sheet. So I'd say the equity markets are being completely irrational, which is
so you
not
think
the
Fed is right and the markets are wrong, and that's why Jay Powell seems to be ignoring the markets?
Well, look, I'd say that the equity markets want certain things in the short term, which might not be beneficial for the long term.
Got it.
Right? If you keep short-term interest rates low for too long, it actually pulls down growth and it pulls down inflation. And anybody